If I had to start investing in AI infrastructure today from scratch, knowing what I know about Neoclouds, GPU demand, power shortages, debt markets, and the way investors are now chasing anything with artificial intelligence attached to it, I would do almost everything slower. Most people think this story is about finding the next explosive AI stock, or buying the company with the biggest data center announcement, or somehow getting in before Wall Street wakes up. But that is not really what this is about anymore. This is about a new layer of the internet being built with borrowed money, expensive chips, tight power supply, and a giant assumption sitting underneath the whole thing. The assumption is simple. AI demand has to arrive fast enough to justify the money being spent right now, and if it does, some of these companies could become very important. But if it does not, then the same infrastructure that looks like a goldmine today can become a very heavy balance sheet tomorrow. Today is Monday, April 27th, New York time. Comment below what day and date you are watching from, because I want to see where this conversation is reaching. And if you value this type of breakdown, subscribe and comment John AG Best. That tells me you want more research like this, and it helps push the video to people who actually need it. So in this video, we are going to walk through why investors are bullish on Neoclouds, why the story is more serious than just hype, and why the risk is also much bigger than most people want to admit. Not because AI is fake. That is not my argument. The risk is that the spending cycle, the financing cycle, and the revenue cycle may not all move at the same speed, and that timing gap is where people get hurt. Now first, what are Neoclouds? Keep it simple. These are cloud companies built mostly around AI computing. They are not the old broad cloud platforms that sell everything from databases to office tools to storage to enterprise software. They are more focused. They are trying to provide the raw horsepower that AI companies need. GPUs, networking, storage, cooling, and the physical data center capacity to run huge workloads. That focus is the attraction. It is also the danger. The attraction is obvious. AI models need compute. Companies want to train models, run inference, fine-tune systems, build agents, power coding tools, automate customer service, analyze data, generate video, and do 100 other things we are only starting to understand. Every one of those things needs infrastructure behind it, not slogans, not keynote speeches, real machines, real power, real cooling, real buildings. Based on recent public numbers, data center electricity demand is already accelerating, and AI-focused facilities are growing faster than ordinary data centers. That matters because compute is no longer just a software cost. It is becoming an energy and capital problem. This is why investors got excited. They look at Neoclouds and see toll roads. If the AI economy keeps expanding, somebody has to rent the lanes. And if you own the lanes, you can collect money while everyone else races across them. Beautiful theory. But let me show you the part hidden in the small print. Building those toll roads is brutally expensive. You need the chips, and the chips are not cheap. You need power, and power is becoming one of the hardest things to secure. You need long-term customer contracts because lenders want proof. You need data center shells, leases, transformers, fiber, cooling equipment, engineers, and time. A lot of time. And while you are building, interest does not politely wait outside. That is the whole Neocloud tension. Investors are excited because the revenue opportunity looks huge. Lenders are involved because the contracts look attractive. But shareholders are exposed because the companies often need to raise money before the profits are fully visible. CoreWeave is the cleanest example because it is public, visible, and huge enough to become the reference point. The company moved from a niche GPU business into one of the most watched AI cloud names in the market. Since its public debut, the stock has had powerful moves because investors see it as a direct way to own AI compute demand. And there is real evidence behind that excitement. According to the latest publicly available company materials, CoreWeave ended last year with revenue above the $5 billion mark, and its backlog expanded to almost $67 billion. That is not a tiny pipeline. That is a giant pile of contracted future business. Even more interesting, recent company updates said the customer mix became less concentrated than before, with no single customer representing more than just over a third of backlog. That matters because early AI infrastructure companies can become dangerously dependent on one or two giants. Diversification is not just nice, it is survival. So yes, the bull case is not imaginary, but here's where I slow down. A backlog is not the same thing as cash in the bank. It is a promise that still has to become delivered capacity, then revenue, then operating profit, then free cash flow after interest and capital spending. And that journey is not automatic. The market loves the first half of the sentence. It sometimes ignores the second half. CoreWeave has also kept raising capital. Recently, it announced major debt and convertible note offerings while also closing a large GPU-backed financing facility. On one hand, that is bullish because lenders are willing to finance the assets. On the other hand, it tells you the business model needs enormous outside capital to scale. Both things can be true at the same time. That is what makes this hard. This is not a simple scam story or a simple rocket ship story, it is a capital intensity story. And capital intensity means the winners can become enormous, but mistakes become expensive very quickly. Now, Nebius gives us the second case study. Nebius raised a large convertible debt package in March to fund AI cloud growth, data centers, GPUs, and expansion. The company also had major customer momentum around big AI infrastructure agreements. So you might think the stock would only go up, but no. The market got nervous, because raising money can mean confidence, but it can also mean dilution, repayment pressure, and future expectations rising even higher. When a company raises billions to build infrastructure, investors immediately ask, how fast does this turn into cash? That question is not negative. It is necessary. If you are successful, share your success story in the comments so others can stay motivated. Now let us talk about the supposed cost advantage. Some analysts argue that specialized AI clouds can deliver certain workloads at a much lower cost than the broad hyperscalers. Maybe. There are reasons it could be true. A focused platform can optimize around GPUs, cluster design, scheduling, networking, and AI workloads instead of trying to serve every possible enterprise customer. But cheaper is not always the same as better. Sometimes cheaper means efficient. Sometimes cheaper means aggressive. Sometimes cheaper means the company is accepting lower returns today because it wants market share tomorrow. Those are very different situations, and investors have to know which one they are buying. Because if your edge is true efficiency, you have a moat. If your edge is underpricing risk, you have a timer, and timers eventually go off. There is also a point that I think many bulls skip. The hyperscalers are not asleep. Amazon, Google, and Microsoft already have huge customer relationships, software ecosystems, procurement power, and balance sheets that can absorb years of investment. They are also building their own AI infrastructure aggressively. So the idea that Neoclouds simply replace them is too neat. The more realistic outcome is that Neoclouds fill specific gaps. They provide speed where the big platforms are constrained. They serve customers who need specialized clusters. They help absorb demand when hyperscalers are full. They may become partners, suppliers, or acquisition targets. That can still be very valuable. But it is different from saying they will dominate everything. And this is where the industry could split. The strongest Neoclouds, the ones with durable contracts, access to cheap capital, strong execution, and real customer diversity, may keep growing. The weaker ones may discover that GPU ownership alone is not a business model. You need utilization, you need pricing discipline, you need uptime, you need customers who pay on time, you need power agreements that do not blow up your economics. You also need patience from the market, and markets are not famous for patience. Fresh industry research shows the broader data center build-out is running into real-world constraints. Power demand is rising fast. Grid connections can be slow. Equipment can be scarce. Construction is not instant. Some states and local communities are already debating how to handle very large data center projects because electricity, emissions, jobs, and utility costs are becoming political issues. That is not a small footnote. That is the physical world pushing back against the digital dream. So when a Neocloud announces another giant build-out, I do not just clap. I ask, where is the power coming from? Who pays if construction takes longer? What happens if chip supply changes? Are customers locked in? Are margins protected? How much debt matures before cash flow catches up? That is the checklist. Now, the skeptical view says AI demand may be overhyped. I think that is partly right and partly wrong. The wrong part is pretending demand does not exist. It does. Companies are already spending, developers are using tools, enterprises are testing agents. Inference workloads are likely to become a much bigger share of compute over time, because using AI repeatedly can require more ongoing capacity than training one model. But the skeptical side is right about one thing. Demand can be real and still not justify every stock price. That is the lesson people forget. In the telecom boom, the internet was real. Fiber was useful. Demand eventually arrived. But many investors still got crushed because too much infrastructure was financed too early at the wrong economics. In railroads, the transportation revolution was real, but not every railroad stock made people rich. In shale energy, the oil was real, the production was real. The problem was the money. Same idea here. AI can change the world, and some AI infrastructure stocks can still disappoint. That is why I would not look at Neoclouds as one basket. I would separate them into categories. Category 1. Companies with strong contracts and proven execution. These deserve attention, even if valuation gets uncomfortable. Category 2. Companies with exciting announcements but unclear profitability. These are dangerous because press releases can look like progress while cash flow lags behind. Category 3. Companies that are mostly financing stories. They may survive, but the equity can get diluted, squeezed, or bought out at a price investors do not like. In Category 4, the suppliers around them. Power equipment, cooling, networking, construction, chips, and data center services. Sometimes the best way to play an infrastructure boom is not the most obvious name on the screen. Now, what would make me more bullish? I would want to see revenue growth paired with improving margins. I would want to see backlog converting into actual revenue. I would want debt financing terms to stay manageable. I would want customer concentration to keep falling. I would want evidence that utilization remains high, because idle GPUs are not assets. They are expensive furniture. What would make me nervous? More debt raised under pressure. Big customers renegotiating commitments. Delays in capacity. Rising interest expense eating the story. Margins moving the wrong way. Or management constantly saying scale will fix everything, without showing when shareholders actually benefit. Scale is not a strategy by itself. Scale is only beautiful when it produces cash. So, why are investors bullish? Because the upside is enormous. If AI becomes a core business layer, compute providers become part of the economy's plumbing. And plumbing is not glamorous, but everyone needs it. The companies that control scarce AI capacity could become incredibly powerful. Why should investors be careful? Because this plumbing is being installed with borrowed money during a period where power, equipment, construction, and customer demand are all moving targets. That is the game. Not good, not bad, just dangerous. And if you understand that, you already have an advantage over the person who buys only because the chart is green. One more thing, and this matters. Recently discussed infrastructure reports are also warning that unused capacity can become a hidden problem. Companies sometimes reserve more compute than they need because they fear shortages later. That can make demand look stronger in the short run than actual usage. So when you hear about capacity being sold out, ask whether it is being used productively or simply being reserved defensively. That difference matters because reserved capacity can support financing for a while, but productive capacity supports durable profits. And durable profits are what separate a real platform from a crowded trade. Very, very important. That is why the next earnings reports matter so much, because investors are not just buying AI demand now, they are judging conversion, discipline, and staying power over time. So here's the simple rule I would use. Do not confuse AI belief with stock discipline. You can believe in AI. You can believe in compute demand. You can believe Neoclouds matter. And you can still wait for a better price, a cleaner balance sheet, or more proof that contracts are turning into cash. There is no shame in missing the first part of a move. There is shame in pretending you understood the risk after the stock falls. The next few years will separate the builders from the borrowers. Some Neoclouds will become real infrastructure giants. Some will become suppliers to bigger platforms. Some will be acquired. Some will discover that building the future is easier to announce than to finance. And that is why this sector is fascinating. It is not just about artificial intelligence. It is about capital, power, contracts, timing, and human psychology all colliding at once. So watch the numbers, watch the financing, watch the customers, watch the grid, and most importantly, watch whether the story keeps moving from promises into cash. Because in the end, the market can forgive a lot of things, but it does not forgive a company that borrows like a giant and earns like a startup forever. Before we wrap this up, remember, this is for education and perspective only. I am not telling you to buy or sell anything, and this is not personal financial advice. Use this as a starting point for your own research, understand the risks, and never let an exciting AI story make the decision for you.